Hello and welcome to this episode of GoldCore TV. I'm joined by Gave of Gavekal, and we're talking about how your investments are going to be affected by higher inflation, unprecedented financial stimulus, and money printing. How money is going to continue to flow to the east, why Bitcoin is not all it's cracked up to be, and why you must own gold, and how your portfolio is like a rugby team. All this and more in this episode of GoldCore TV. Louis Gav, welcome to GoldCore TV.
Thank you very much for having me.
It's great to have you on here. And really what I'd like to do for our community and our listeners is to kind of look at the big picture stuff, the big themes that we're going to see in 2021 and beyond. And I know this is very much your forte. And obviously we can't start this conversation without first talking about the impact of COVID-19 and the global impact, the impact on the global economy. How do you see it unfolding?
Well, obviously, COVID-19 was a massive exogenous shock for the system, something that sort of came out of the blue and for which our systems weren't really appropriately prepared. And I think perhaps one useful parallel was the 1970s oil shocks. When oil prices in 73 and again in 79 basically tripled and quadrupled literally overnight. Those were massive shocks at the time for energy-intensive economies, massive shocks that economies weren't ready for. And if you look at the response, the policy response of Western countries at the time to those exogenous shocks, there were really two separate responses. The first, you had the US, you had Britain, you had France that decided to monetize that shock, decided to say, okay, this is going to be a big hit for our consumers. It's going to be a big hit for our businesses. Let's accompany them. Let's print a bunch of money to help them out. And then you had countries like Germany, like Switzerland, like Japan that said, no, let's not do that. Let's not monetize this shock. Let's take the pain up front and we'll be better for it in the long run. And those countries ended up seeing massive revaluation of their currencies vis-a-vis the French franc, the sterling, the US dollar that basically took big hits. And I think the reason I'm drawing this parallel is I think we're broadly seeing the same thing today. We've had a big exogenous shock, and then you've had the countries that have decided to monetize this shock, and none more so than the United States. If I asked you, what is today the growth rate of M1 in the United States? So the monetary aggregate M1 in the United States. You might be shocked to learn that growth rate today is 70%. Never before in history as a major economy had an M1 growth rate of more than 30%. We have just blown through in terms of monetary creation anything that we've ever done in the past, at least in the United States. So today you have the countries that have monetized this COVID crisis and the countries that have not monetized the COVID crisis. And frankly, a lot of the countries that have not monetized the COVID crisis stand mostly out east. They stand in Hong Kong, they stand in China, they stand in Korea, in Singapore, so forth. And so today, if you're going to own fiat currencies, I think you want to own fiat currencies, you want to own cash exposure, you want to own fixed income exposure in the countries that are not monetizing this crisis, not in the countries that are.
So does that mean that we're going to see a movement of funds and investments, or a continued movement of funds and investments, money going east?
Exactly. I was going to say continued because it's already started. You look at, the flows into the Chinese bond market last year was roughly 100 billion US dollars into Chinese government bond markets from, roughly nothing the year before that. For this coming year, Goldman Sachs, basically by just simply projecting the most recent months forward, is assuming that you'll have about $140 billion of Western money going to Chinese government bonds. I actually think it's going to be more than that. I think it's going to be more than that for the simple reason that today, real rates are massively negative pretty much across the Western world, and they're only going to get more negative from here. They're only going to get more negative because if you think of the inflation rate over the next 6 to 9 months, the inflation rate, you're going to get some pretty high prints. You're going to get some high prints simply because of the base effect. In March, April, May of last year, you had oil prices go down to $40. You had everybody stuck at home. You had prices collapsing everywhere. So the year-on-year comparisons for inflation are going to be pretty shocking come this spring and this summer. And against that, you're going to have thus very negative real rates. And as people look at the Western world's negative real rates, they look at Asia's positive real rates. This is where the bond money will flow. That trend has already started. It's only amplifying from here.
So it's a natural flow then of money moving from west to east, continuing in 2021 and beyond. You touched on inflation.
I think it does. To be honest, I'm sorry to interrupt you, but I think that flow continues until we stop our current fiscal policies and monetary policies. And again, I'm sorry to interrupt you, but you look at the United States. Last year, the U.S. federal government, forget states, forget municipalities, etc., added $12,800 of debt per single living American.
Wow.
This is an increase in debt such as we have never seen in any country through history. And to me, the really shocking thing is this $12,800 increase in debt has gone to fund absolutely zero new productive investments. It's not like they've built a new Hoover Dam or a new Tennessee Valley Authority or a new interstate highway system. It's $12,800 that has gone straight into consumption. It's gone to pay people to sit on their couch and watch Netflix and play video games. So that increase in $12,800 in debt, how is it going to be paid back? Is it going to be paid back through an increase in productivity? Well, how, when you haven't made any productive investment? Instead of making productive investment, what you're doing is you're actually increasing regulations and making it harder for businesses to operate. So what seems to be more likely to me is the only way this money can get paid back is through more money printing. And when you go down the path of more money printing, usually it leads to a collapse in productivity, not an increase in productivity. So the bottom line is when you look at the policy mix today in the United States with massive fiscal easing funded by money printing such as we've never seen, yes, it's going to continue encouraging flows out of the United States dollar. And this especially after a decade where you had very large positive inflows into the US dollar. Now, all this foreign money that has come into the US, and foreigners have never been more overweight the US than they have today. It's simply on the premise that the US was the world's cleanest dirty shirt. A lot of that foreign money is going to start coming back out. And I think you're already seeing that. You're already seeing it. Look at the past 6 months. The past 6 months, you've seen bond yields rise and you've seen the US dollar fall. Now, I've been based in Asia for 20 years. My starting point when I see yields in the country rise and the currency fall at the same time is that country has experienced capital outflows. Now, that's the typical emerging market picture where when interest rates rise and the currency falls, it means capital is leaving. And that's where you are today in the US. So yes, the trend has started. And I think until monetary policy changes or until fiscal policy changes, that trend is now set.
What does the weaker dollar mean then for the rest of the world?
Well, incidentally, I think the first down phase in the US dollar is welcomed by almost everybody. A weak dollar typically is great news for emerging markets because so much capital spending in emerging markets takes place in a weak dollar, in a US dollar. So when the dollar is weak, it's a lower cost of funding. So it's great news for emerging markets. It's great news for the US Midwest, right? For all those swing states like Ohio, Michigan, Pennsylvania, Wisconsin. It's great news for US manufacturing. So US policymakers will likely applaud the first down wave in the US dollar because it will mean more jobs in the Midwest, a higher earnings power for the US blue collar workers. So, the first phase of the US dollar is probably, frankly, good news all around.
And then after that, what are the long-term impacts?
Well, there's no free lunch, right? And the first phase is, it's a boom all around. The second phase, inflation accelerates. And then that's when the US consumer starts to say, well, hold on, this just isn't that great. Now, as we know, inflation is a tax on poor people. Inflation hurts disproportionately the people who live paycheck to paycheck, right? Because they're the ones who consume the entirety of their paychecks. And so the big risk of the weaker dollar is it leads to higher inflation in the United States, and from higher inflation, you get social strife. You know, I'm French originally. I grew up in France, and so you can take the boy out of France, but you can't take the Marxism out of the boy. Having been brought up in the French educational system, I'm somewhat of a Marxist at heart, at least when it comes to the study of history. And you know, for Marx, every revolution was basically triggered not by ideas, not by individuals, but first and foremost by economic forces. That's the moving shape of history, is economic forces. And there is no greater economic force than inflation. So, you know, Marx basically explains, look, you had bad harvests in France, food prices went up, and before you know it, Louis XVI's head is on a spike. And, you know, you saw this just recently with the Arab Spring, right? Food prices were going up, oil prices were going up, and before you knew it, you had revolutions all across the Middle East. I'm not saying you're going to see a revolution in the United States, but what you have in the United States today is definitely a very tense social and political situation where, you know, you have maybe 20% of Americans who feel very strongly that Bernie Sanders was cheated out of his run to the presidency. Then you have probably 30% of Americans who feel very strongly that Donald Trump had his election stolen. And I'm not saying I believe that. I'm just saying that, you know, you now have a large percentage of Americans that seem to believe that their system no longer represents them. And against that, you throw inflation on top of it, and it makes for you know, potentially big social strife. Incidentally, you know, we've already seen social strife, I would say, because of inflation. If you look at the Yellow Jacket movement in France, it was triggered first and foremost by a rise in gas prices at the pump. If you look at the events we had in Hong Kong, it was partly triggered, I believe, by the fact that real estate has become unaffordable. And frankly, if you look at all the Black Lives Matters riots we had in the United States, of course, these were nominally linked to racial justice, but when you have people rising up in this way, it's very often because they can't make ends meet. So we may already be there with the inflation at the low end already going up, inflation for food prices, inflation at the gas pump, and that this is already starting to create strife.
And has the US, have they painted themselves into a corner though? Because the one tool that they're going back to, most central banks are in the world anyway, they're going back to the whole time is printing money. It seems like, as I said, it's the only tool in the toolbox. What else should they be doing? Could they be doing, or is there anything?
I'm not sure that there is. To be honest, I do think the Fed is a little bit painted in the corner where, if you look at the coming year, the Fed is going to have to roll over $8 trillion of US government debt. The US government is going to have to roll over $8 trillion of debt, on which you can add roughly $2 trillion of deficit. And then President Biden is talking of adding another $1.8 trillion of deficit on top of that. And $1 trillion here, $1 trillion there, pretty soon you're talking real money. And if you look at the amount of debt that is coming to the market over the coming year, there is no way that the market can absorb this. And the Fed actually acknowledged just as much recently. You look at a declaration by Governor Quarles, who basically said, if the Fed doesn't intervene, the bond market is going to break down. And so the bond market's become too big to be left to his own device. And so, once you get there, yes, you're stuck in this quandary where either you print to prevent the bond market melting down, and if the bond market melts down, the equity market melts down, and you have a problem. But by printing, you almost guarantee that the US dollar is on a structural downward path.
And tell me whether you agree with me or not on this, but I mean, we've seen massive run up in US stock markets over the last year. We've hit record highs. Now, Presumably that is as a result of the amount of money that is being printed and that money actually flown into the stock market, because a lot of these companies, rather, the fundamentals don't necessarily support these type of valuations that they have.
Are you not a GameStop? Are you not a GameStop buyer?
We won't go there in this conversation. But does that mean that as more money gets printed, that stock markets benefit from this and continue to new highs, or are we at some stage going to see a kind of dawning of reality and see that money flow elsewhere, as you suggest, flowing out of maybe the US? And is that how we see it flowing east?
So I think you touch on a lot of things on this question. So the first point I'd make is we are living in exceptional times in that, you have signs of froth in so many different places. The listing of SPACs, this GameStop, AMC, BlackBerry, et cetera story, this, the cryptocurrency space, the melt up in anything to do with electric vehicles. I mean, the examples of froth are so many. And this is all occurring at a time when the US equity markets, take any measure, PE, price to book, price to sale, et cetera, is in the top decile of its valuations. So, you feel like I can't possibly buy equities today because once they crash, clients will ask me, well, what the hell were you thinking? It was obvious, right? You had all the traditional sign. If you've read any books about past manias and past, speculative bubbles, we have all the signs today. The one big difference from previous speculative bubbles, of course, is that in the past, when these kinds of things were occurring, the central banks were busy taking the punch bowl away, right? This was always the big, their role. The threat and their role in the market. It's when the party gets going, they basically turn on the lights. When things start to get a little hot and heavy. Well, fast forward to today, and instead of pulling the punch bowl away, the central banks are basically saying, hey, this party's getting going. Let's add some rum into the punch bowl. And here they are spiking the punch bowl. So it is very different. So what do you do about it? Well, I think you have to build a decently diversified portfolio. And the way I've often talked to clients about their portfolios is I say, look, building a portfolio is a little bit like putting a rugby team together. So I play a lot of rugby. I still play today, and I'm involved with a rugby club in France. So rugby is a big part of my life. So I often use rugby analogies. So I look at, I'll say building a portfolio is like building a rugby team. When you build a rugby team, you need people of different shapes and sizes. You can't build a rugby team with 15 Georgian props, even though they might be the best props in the world. And you can't build a rugby team with 15 Fijian wingers, even though they might be the best wingers in the world. You need things of different shapes and sizes. Now, for me, your equities are your Fijian wingers. When everything goes well, they're terrific. They're, they can run through the opposition, etc. But if it gets cold, if it gets rainy, if they don't like the conditions, they might just not show up. Historically, for me, bonds have been your Georgian props. Dependable, ugly. If ever there's a fight, they'll be the first ones to show up. The big challenge today, I think, for most investors is that those Georgian props, well, they went on holiday over the summer, and instead of coming back weighing 135 kilos, they went on a diet, and they're now weighing 70 kilos. Right. Because instead of offering 1.5% real, they're now offering minus 1.5% real. Now, so they're the Georgian props are now the 70 kilo prop. Now, who needs a 70 kilo prop in a scrum? So the first challenge is, the old story, no scrum, no win. The first challenge of portfolio construction today is where do you get your anti-fragile asset? Knowing that bonds no longer represent the anti-fragile asset, because you can own the equity. For sure, you can own the equity, but what's going to diversify your risk when, whatever happens, that the day the central banks say, okay, the party's over, that day the equities tank. And who knows when that's going to happen. But it at some point it will, because it just does. And so the big challenge is, okay, you have your Fijian wing. They're your stocks. You have them and you need them. Now, for me, the big challenge is not whether you want Fijian wings. The big challenge is, how do you replace the anti-fragile bonds in your portfolio? And I think there's only two possibilities, and I would use both, by the way. One of them is Asian bonds, because Asian bonds still offer positive real rates, and because they're not monetizing this COVID crisis, their currencies are now structurally strong and will remain structurally strong. So the first option is Asian bonds, and the second option is gold, or precious metals in general, because gold historically has been a sound anti-fragile asset. Although the way I explain gold is, to me, gold is very much, it's a highly temperamental player. It's a great player, but you never know who shows up on the pitch. Sometimes it has the best game of any player you've ever seen, and sometimes it just doesn't. So it's a very frustrating player to have on the pitch if you're the coach. It's a little bit like, I don't know if you remember Frédéric Michalak, who played for France.
I do indeed, yes.
He was either terrific or a shocker.
Yeah.
And there was nothing in between. So what the coaches ended up doing was they put him on the bench for the last 30 minutes. If France was down by a lot, they'd put him in. If the game was already lost, to be like, well, let's see what he can do, because game's already lost. And sometimes he turns it around, as he did against the All Blacks in 2003 at the World Cup quarterfinal. And sometimes we'd ship in another 20 points, but it was okay because the game was already lost. Well, this is what gold is. You have to have gold at least on your bench, because when things are really dire, it might turn the situation around for you. And so but especially at a time when there aren't a lot of anti-fragile assets going.
I love that analogy. It's fantastic. I've never thought of it that way before, but I don't think I'm going to be able to think of it any other way from now on. Talk to me for a moment, actually, now that you've touched on many different asset classes there. But now we've seen in the last year, and particularly in the last couple of months, the phenomenon that is Bitcoin. What are your thoughts on Bitcoin? Because there's a lot of people saying that, because Bitcoin has performed well, throughout this last year during COVID, that it's some sort of a safe haven asset. What's your view on Bitcoin?
Well, so first of all, it's hard to know whether Bitcoin genuinely is an anti-fragile asset or not, because it doesn't have that much track record. Gold has hundreds of history, thousands of years of history of track record. Bitcoin is brand new. The first thing I'd say is, to me, Bitcoin doesn't feel and act like an anti-fragile asset. An asset that can go down 80%, as it's done several times in the past few years, is not anti-fragile to me. It doesn't cushion the downside volatility in the portfolio. I'd go one step further. To me, Bitcoin seems decently correlated with the NASDAQ. Partly because I think it reacts as well to all the success liquidity creation, just like the NASDAQ has. But also because a lot of the people who have been long Bitcoin are your Silicon Valley entrepreneurs. So it's the same guys that own the tech stocks that typically own the Bitcoin. So if they take a hit on one, they usually let go of some of the other, or at least there's less, or if the people who buy the tech stocks are the same people who buy the Bitcoin. So if they stop buying that, they also stop buying the other. And so increasingly, Bitcoin is behaving as a sort of high beta play on the NASDAQ. Now, again, going back to the idea of, I want to put my best potential rugby team on the pitch. Do I need a high beta play on the NASDAQ in my portfolio? Do I need something that has, twice the volatility and twice the returns of the NASDAQ? I'm not sure that I do. I'm not sure that adds much to my portfolio. If I want that, I can go out and buy the NASDAQ, and that's plenty fun enough for me. That's plenty enough volatility. I don't need to strap on more volatility. So that's the first point I'd make. The second point I'd make on Bitcoin is to question this whole narrative as to whether it's the currency of the future. You may remember Bitcoin really started hitting headlines 6-7 years ago And back then, the Bitcoin proponents were saying, well, look, in the near future, we'll all have our Bitcoin wallets in our phone. And when we go to Starbucks to buy coffee, we'll just swipe our phone and get deducted the Bitcoins. Fast forward 6, 7 years, 8 years, still nobody's transacting anything in Bitcoin. And 5 years from now, I doubt we'll be transacting in Bitcoin, partly because any transaction in Bitcoin costs $10 of energy. So it's just too expensive a transaction to ever be used as a means of exchange. Now, a currency needs to be a store of value and a means of exchange. And frankly, Bitcoin fails at the hurdle of means of exchange. Then you get to the question mark is, will it be a store of value? Now, I struggle with a store of value that goes up and down 80% in the space of a few months. So that's the first point I'd make. The other point I'd make is that I struggle with a store of value that could conceptually go to zero. I think the big difference between gold and Bitcoin as a store of value is there's always going to be a price for gold, if only for its use as a commodity. It's used in, if gold prices fall enough, electronics manufacturers start to use more of it. There is an industrial use to gold. And so, which, Bitcoin, it's not that there's not only industrial use, is that it actually uses up energy, and it uses up a ton of energy. And so, I think if we go to fast forward and we live in a world where energy prices are going up, which I believe we will, where all of a sudden, regulators start to crack down on Bitcoin, where tax authorities start to tax it, then what you're left with is really Bitcoin becomes a collectible like any other collectible. So just like Petrus bottles of wine, or just like 1962 Ferraris. But if I own a 1962 Ferrari, I know why I own a 1960. I don't own one, by the way, but if I owned one, I know why I would. It's because I enjoyed looking at it and enjoyed driving it. If I own Petrus 82 bottles, which I also don't, I know why I own that. Although the problem with those is I wouldn't own them for very long, probably.
They have a utility value.
They do have a utility value. The big problem with Bitcoin is, like, what enjoyment do you get out of your Bitcoin? For me, it's a collectible with basically zero enjoyment. So yeah, I struggle with it.
All right, fantastic. Listen, before we wrap up here, how can people in our community learn more about what it is that you do?
Yeah, I think, well, look, the easiest way is probably to go to our website, which is gavekal.com. That's Golf Alpha Victor Echo Kilo Alpha Lima.com. And yeah, I'm not really on social media. So yeah, the best thing is, go to Gavekal, or go to Evergreen Gavekal, which is our private wealth business. And there we have a free newsletter. So if people want our free newsletter, it's on Evergreen Gavekal. Gavekal.com is our institutional products, both on money management and on research.
Well, I'll put a link to both of those down in the description below.
Oh, thank you. Perfect.
But for now, Louis Gav, thank you very much for joining us on GoldCore TV.
Thank you very much.
Thank you for watching GoldCore TV. Remember to like and subscribe and hit that notification bell, and share this with anybody you think will be interested in it. You can also stay up to date with everything precious metals related on goldcore.com.